Here I'm going to share with you the 4 cardinal trading rules of trading stocks. We'll talk about how to buy and sell shares, and I'm going to incorporate some live trading segments here on how this is done so you can see real time just exactly how to do this inside my platform. So you're also going to understand really the importance of options and why you need to understand them, because there's a relationship that you'll learn between stocks and options and how that marriage exists and how you can use that to your benefit. So we'll also get into some further modules and talk about some of the option trading strategies that we're going to be building on from here. But this is a very important module because you're going to have that foundational knowledge of how stocks and options relate to each other. We'll talk about some key profit-taking strategies, and you'll learn about level 1 options trading, which is known as selling a covered call, a very effective and conservative strategy that you can use in not only an IRA account, but also your regular brokerage account. So I'm going to show you how to sell covered calls on shares of stock and teach you the art of buying back sold calls, because there's some hidden things that you need to understand with that. And we'll cap off this module 5 with some live trading examples to help demonstrate how all this is done and how it works. So let's go ahead and jump right in. You have to have these 4 cardinal rules every trader must live by to succeed, whether you're trading stocks, options, or really any financial instruments. You have to cut your losses short. You have to also, on the flip side, let your profits run. The last one here is you have to manage your risk. So it's important that you understand that you buy at the ask price and you sell at the bid. When you're going long, you buy to open, you sell to close. And then when you go short, you sell to open and buy to close. Whether you're going long or short, you're always going to buy at the ask and sell at the bid. 100 shares of stock is the equivalent of 1 option contract. I'm going to go deep and so vast into options later in the program because I love trading options, and I'm going to teach you how that works. This is the takeaway, is just know what you can create, what you can achieve on the same underlying stock when you have the ability to trade the options versus the stock. It gives a shareholder the ability and the right to sell a call option on the owned security as long as it has listed options. And not all stocks are optionable, so this strategy that you're going to be learning in the subsequent parts here is not going to be available on all the stocks out there in the stock market. There's over 1,000 stocks that are optionable that have listed options to sell covered calls or just trade options in general. So that's important to understand, that it gives someone else the right, but not the obligation, to buy your stock from you at the strike price at which you sold. It's typically done for 1 to 2 months out because option premium and the decay is the highest at this time frame. You can do it on a weekly basis because we have weekly options now that are out there, but it's best done under a 60-day period, meaning if you sell a covered call, you want to do so as soon as possible because options that are under that 60-day window, they expire and they decay the fastest. And when you flip the scenario, when you buy an option, you don't want the expiration to come, because every day that passes, you're fighting the clock, you're fighting that time decay, because options are decaying assets. It can be done on both stocks you want to sell and that you don't want to sell. Most brokerage companies are going to approve you for this out of the gate because it's so safe. You're securing your sold option contract, your sold covered call, because you already own the share. So there's not a lot of risk from a brokerage standpoint. It's mainly, what are your risks? There's 3 things that can happen. The first thing is that the stock goes above that sold strike price. That's really the second to worst case scenario. You have to buy back the sold call option for probably a loss, but the profit will be made back and more on the actual stock that you own. Part 2 is the stock can stay flat or below that sold strike price and you keep the premium. That's great. You continue doing it next month. And then the third strategy, or the third outcome, is if the stock goes down and you sell that 105 call option, you keep all the premium, but you would be down. It would offset some of your loss. You have to have option trading privileges for level 1. I recommend that you have this set up in your IRA account, because if you own shares of stock and they're going sideways and they're not really doing anything for you, this is a great way to start taking that asset that you own and getting some type of positive cash flow income generation that can help increase your overall profit equity curve. And that's what it's all about, utilizing things that, as the market changes, really 50% of the time we're going to be in a sideways trend. It's almost free money, and if you still want to hold on to your stock, that's great. I'll show you how to manage, and I'll show you the whole art of buying back sold calls and what happens and how you do it. Finish this off by understanding that the principles when you sell a covered call, there's a couple things that can happen. The couple things that can happen are, number 1, you get called out of the stock because the strike price that you sell of the option, the stock goes above that on expiration, so you have to do something. If you don't do anything, you get called out of your stock and you keep the premium, which is fine, but you lose some of the upside potential. The risk on that first scenario is you have lost upside potential, meaning you limit your profit gains because of the sold call that you did. The second one is that the stock stays flat. If the stock stays flat, that's great. A lot of times you'll keep that majority of the premium. You could buy it back for a lot less than what you sold it for, the covered call or calls, depending on how many shares you have, and be able to do that process over and over again and just keep the positive theta income generation rolling week after week, month after month. And then that third scenario is when the stock goes down and you sell that covered call that expires worthless. You keep all the premium, but I have this stock that now I'm down all this money in. What do I do? That's actually the trickiest part, because now you're down money. You don't want to sell a strike price covered call that's really below the price that you purchased the stock for, because then you're basically securing a loss. So that's probably the hardest part to understand, but I'm going to alleviate that by showing you, as I love to do, some live examples here. And that's how it works. I love the strategy. It works very well. A lot of people have great success with this, and they increase their yearly returns by putting this great strategy to work, getting an extra couple percent a month or every quarter. By doing this, it's something that puts the odds in your favor. It's going to keep you in the game for the long term. That's what we're all about. I'm going to keep hammering this home because I love it, and I think you're going to love it too. So I'll see you in the next part. Thanks so much for watching.